Welcome to Talk Tickers. Today, we're actually doing something a little different than our usual format.
Yeah, a bit of a pivot for us today.
Right. Usually we're dissecting earnings calls.
Yeah.
Looking at the top line, the bottom line, the forward guidance. We're generally obsessed with the companies themselves. But today, we're zooming out.
Way out.
Yeah.
Yeah.
We're looking under the hood of the portfolio itself. Because here's the premise, and this is for everyone listening, you really need to grasp this. Most investors spend their entire lives obsessing over pre-tax returns.
Oh, absolutely. It's the only thing people look at.
Right. They're chasing alpha, they're trying to time sectors, picking managers, or frankly, just praying the market goes up.
Or bragging about whatever tech stock they bought last week.
Exactly. But the biggest drag on your portfolio, the silent killer of your wealth, usually isn't the management fees. It's not even poor stock selection, honestly. It is taxes.
That is exactly right. And it's the one thing nobody wants to talk about because, let's face it, it's not sexy.
No, not at all.
It is not exciting to talk about tax efficiency at a cocktail party, right? You want to talk about how you bought NVIDIA at $100. But the reality is what you actually keep, what lands in your pocket is the only number that matters.
A net. The absolute net.
Right. And we are currently in the middle of a massive, a truly structural shift in how people actually own the market to maximize that specific number.
Okay, so I want to frame this shift for you, the listener, before we really get into the weeds of this deep dive. Because we spent the last, 30 years moving from high-fee active mutual funds, where you paid some guy in a suit to try and beat the market, to low-cost, tax-efficient ETFs.
Yep. The Vanguard revolution, basically.
Right. That was the era of, let's call them pooled investment vehicles. You put your money in a giant pot with everyone else. But now, because of technology, that door has opened to unbundled ownership. We are entering the era of direct indexing.
It really is the next logical step.
Yeah.
If the ETF was the democratization of low-cost investing, direct indexing is the democratization of high-end institutional tax engineering.
And the value proposition here is highly specific. I want to be super clear up front. This isn't just about customization, although we are definitely going to get to that.
Oh, we have to. It's a huge part of it.
But at its core, it's about manufacturing something called tax alpha. It's about using the tax code itself to generate a yield enhancement that just flat out doesn't show up on a standard performance chart.
It's invisible yield.
Invisible yield. I like that. So let's define the scope of our mission for this deep dive today. We are looking exclusively at the mechanical differences between owning an ETF and owning the underlying basket of stocks via a separately managed account, an SMA.
Correct. And just to be crystal clear so nobody gets the wrong idea, we are not discussing stock picking today.
Right. No crystal balls here.
Exactly.
Right.
We aren't trying to predict if tech is going to be energy next year or where interest rates are going. We are not predicting market direction at all. This is purely about structural efficiency. It's the plumbing.
The plumbing of wealth management. I love that. Okay, let's unpack this plumbing. Let's start with the basics, the foundational stuff. Most people listening right now probably own an S&P 500 ETF like SPY or VOO or maybe a total market mutual fund.
Very common, the default for most, really.
Right. They log into their brokerage, they buy the ticker, they see one single line item in their account. It's clean. It's incredibly simple. What is actually happening there under the surface, and how is direct indexing fundamentally different?
So when you buy an ETF or a mutual fund, you really have to remember what you are actually buying. You are buying a wrapper.
A wrapper.
Okay. You own shares of a fund, and that fund is what owns the shares of the actual companies. You are essentially one step removed from the underlying assets. I like to say you're a passenger on a bus.
And on a bus, you go wherever the driver goes.
Exactly. And more importantly, for our topic today, you are subject to the bus's collective reality.
Meaning what exactly?
Yeah. Meaning you are pooling your tax situation with thousands of total strangers. Let's say the fund manager has to sell stock to meet redemptions right. A bunch of other investors panic, the market dips, and they want their cash back.
Okay, so the manager has to liquidate positions to pay them out.
Right. And if they sell shares that have appreciated, that sale triggers a capital gain inside the fund. And guess what? You, sitting there doing nothing, being a good long-term investor, you might get hit with a capital gains distribution at the end of the year, even if you didn't sell a single share of your ETF.
Man, which is, frankly, That is infuriating. It feels like getting a speeding ticket when you were just sitting in the passenger seat reading a book.
That is a perfect analogy. You're paying taxes on a gain you didn't even participate in creating purely because of the structure of the vehicle.
So how does direct indexing fix that?
It flips the model entirely. Instead of buying the wrapper and a bus, you just buy the ingredients yourself. You open a separately managed account, an SMA, and you buy the individual securities directly.
No middleman fund.
Yeah, no middleman. If you want to track the S&P 500, you, or more accurately, the software managing your account, physically buys the stocks inside the S&P 500. You actually own Apple, you own Microsoft, you own Johnson & Johnson.
They show up as individual line items.
Yes, they're all individual line items in your own personal account. You are no longer on the bus, you're driving your own car.
Okay, I get the concept, but hold on a second. Let's look at the reality of this. The S&P 500 has, well, roughly 500 stocks. The Russell 3000 has 3,000. If I have, say, a $100,000 account, am I literally buying 3,000 tiny microscopic positions? That sounds like an absolute administrative nightmare.
Oh, it would be.
My monthly brokerage statement would literally be the size of a phone book.
Right, and nobody wants that. And that is where the sophistication of the software comes in. You don't actually buy everything. That brings us to what we call sampling optimization.
Sampling, like a taste test.
Sort of. For smaller accounts, or even moderately sized ones, let's say anything under a couple $1 million, you don't buy every single stock in the index. You buy a highly representative sample.
Walk me through that. Because how does an algorithm decide which stocks actually make the cut and which get left out?
Think of it like a political poll.
Okay.
If you want to know who is going to win a national election, you don't call every single voter in America. That's impossible.
Right, you'd never finish.
You call a representative sample, a specific mathematically calculated mix of demographics that perfectly mirrors the country as a whole. The direct indexing algorithm does the exact same thing for the stock index.
So it looks at the characteristics of the index.
Exactly. It says, okay, I need to track the S&P 500. I absolutely fundamentally need to own the giant mega caps, your Apples, your Nvidias, your Amazons, because they are so huge. They physically move the needle of the entire market.
You can't replicate the S&P without the top 10. They're like a third of the weight anyway.
Right. So you own all of the top 50 or maybe the top 100 stocks, period.
Okay, that makes total sense. But what about the little guys at the bottom?
That's where the sampling really does the heavy lifting. When you get to the bottom 400 companies, they're much smaller. Their individual movements don't drag the whole index around as much, so the algorithm looks at them and says, I don't necessarily need to own both Home Depot and Lowe's to get my target exposure to home improvement retail.
Because their stock prices historically move in tandem anyway.
Precisely. They are highly correlated. So the algorithm just buys Home Depot. Or it looks at the financials and says, I don't need all 5 of these specific mid-cap regional banks. I'll just buy 2 of them that historically correlate perfectly with the overall group.
So it's essentially building a fruit basket that tastes exactly like the whole orchard, even if you didn't pick every single apple off every single tree.
That's a great way to put it. You might end up owning, say, 140 stocks out of the 500, but the mathematical goal is to keep your tracking error to an absolute minimum.
Meaning your returns shouldn't drift from the actual index.
Right. Your returns should look almost identical to the benchmark. If the S&P 500 is up 10% for the year, your custom basket of 140 stocks should be up 9.9% or 10.1%. It's incredibly tight.
Okay, so I own the stocks directly. I've unbundled the ETF. I have this tailored basket of 140 stocks that perfectly mimics the broader market. But my question is, why?
The $1 million question.
Why go through all this trouble? What is the actual tangible advantage of having 140 individual line items instead of one clean, easy ticker symbol?
The advantage boils down to one word: granular control. When you own the ETF, it's a monolith. It's a solid block of concrete. It's either up or it's down as a single unit. You cannot touch the insides.
Right.
But when you own the 140 individual stocks, you can manipulate those individual components. And the absolute core engine of that advantage, the primary reason anyone does this, is tax loss harvesting.
Tax loss harvesting. That is the heart of the whole strategy. We hear that term thrown around a lot in financial media. It sounds vaguely agricultural. But let's actually break down the bare mechanics of it. How does it work in actual practice? Because just on the surface level, purposely selling things for a loss sounds like terrible investing.
It does sound counterintuitive, doesn't it? But it relies on a fundamental truth. The market is not a single, unified organism.
What do you mean?
We watch the news and they say the market is up 10% today, but that is just an average. It's the lie of averages. Underneath the surface of that 10% gain, individual stocks are incredibly volatile.
They're bouncing all over the place.
Exactly. Even in a roaring bull market, a significant portion of the index will be down at any given moment. A company misses an earnings estimate, or a specific sector gets hit by a new piece of regulation, or a CEO quits in a massive scandal.
Right. So the overall index is up. Everything looks great on the surface, but maybe the energy sector is quietly down 20%. Or maybe just one specific pharmaceutical company completely tanked because their phase 3 drug trial failed.
Spot on. Now, if you own the ETF wrapper, you can't do anything about that pharmaceutical loser.
Yeah.
You're just stuck dragging it along inside the fund.
Because you only own the fund's shares.
Right. But if you own the individual stocks directly via SMA, you can isolate that specific loser. So here's how the strategy actually executes. The software managing your account scans your entire portfolio every single day.
Every day. Not just at the end of the year like traditional tax planning.
Every single day. It looks for any individual stock that has dropped below your original purchase price, your cost basis. Let's say you bought a block of stock in a tech company at $100 a share, and today it drops to $90. You now have a $10 paper loss.
Okay, I'm with you.
The software automatically sells that specific tech stock. It realizes that $10 loss. That loss is instantly banked. It goes into your personal tax bank. It has essentially transformed from a market loss into a tax asset. You can now use it to offset real capital gains you have elsewhere.
But wait, hang on. If I sell the stock, I'm out of the market. If that same tech company announces a massive new product breakthrough the very next morning and the stock jumps to $110, I completely miss the recovery.
I mean, that's the classic retail investor mistake, isn't it? Selling low in a panic and missing the rebound.
That would be a huge mistake. And that is exactly why the critical second step happens simultaneously. You do not go to cash. You never, ever sit on the sidelines in this strategy. The algorithm immediately buys a correlated substitute.
The correlated substitute. This is the famous Coke for Pepsi trade.
Exactly. That's the classic textbook example. Let's say you own Coca-Cola and the stock drops 10%. You sell Coca-Cola, book the loss for your tax bank, and in the exact same millisecond, you buy Pepsi. Or you sell Home Depot and buy Lowe's. Or you sell Exxon and buy Chevron.
You're swapping one asset for another that is statistically almost guaranteed to move in the exact same direction.
Correct. You are maintaining your market exposure.
So you stay fully invested in the soft drink sector or the energy sector. If the sector recovers and rallies next week, Pepsi rallies, and your portfolio participates fully in the upside.
Exactly. Your economic position in the market hasn't really changed at all. You still own a massive global soda company, but your tax position has changed dramatically. You have legally booked a loss on paper that you can use to significantly lower your tax bill with the IRS.
So the end goal is just systematically banking these micro losses to offset your macro gains. And the massive distinction here, the thing you really need to understand, is that an ETF manager can only harvest losses at the fund level to offset fund level gains. But in a direct indexing account, these harvested losses are entirely personal to me.
Precisely. And that is an unbelievably huge distinction. Those losses are portable.
Portable, meaning I can take them outside the stock portfolio.
Yes, they don't just sit there offsetting stock trades. Let's say you are a successful entrepreneur and you finally sell your business for a $5 million gain.
Which is a massive tax event.
Huge. Or maybe you sell a rental property you've owned for 20 years. Or you work for a tech company and you have a bunch of concentrated, highly appreciated stock from your employer that you finally decide to diversify out of.
Any of those trigger huge capital gains taxes.
Right. You can take all those losses that your algorithm has been quietly harvesting in your direct indexing account all year long and apply them against those massive outside gains.
Wow. It effectively becomes a tax shield generator for your entire financial life, not just your retirement account.
It is a highly portable tax asset. And that is exactly why wealthy investors absolutely love this structure. It's not just about trying to squeeze an extra 0.5% out of the S&P 500. It's about how the S&P 500 interacts with the rest of their personal balance sheet.
Okay, so let's actually talk numbers here. Let's quantify this. What is this machinery actually worth to the investor? We keep using the term tax alpha. How do we put a number on that? Because usually when we say alpha on this show, it means beating the market by picking better stocks. Here, we're talking about beating the market by just paying the IRS less money.
Right. So tax alpha is specifically the improvement in your net after-tax return that is generated solely by this daily tax management. It's the physical money you keep that the government doesn't get to take.
And what does the data show?
Well, historical simulations, and we have a ton of robust data on this now from various institutions, suggest this strategy can be worth anywhere from 1% to over 2% annualized.
Annualized. Every year.
Every year. And that depends heavily on market volatility and, of course, your personal tax bracket.
1% to 2% doesn't sound like a massive number when you just say it fast in passing. But let's actually run the math on a decent-sized account. Let's say $1 million portfolio. That is $10,000 to $20,000 a year in straight cash value.
Exactly. Just pure cash savings. And you have to remember how hard traditional active mutual fund managers work to try and beat their benchmark by just 50 basis points.
0.5%.
Right, 0.5%. And statistically, the vast majority of them completely fail to do even that over a 10-year period. Here, with direct indexing, we're talking about potentially generating 100 or 200 basis points of alpha simply by managing the tax bill efficiently. It is a staggering mathematical edge over time.
And you really have to think about it in terms of cash flow versus the fees you pay for the service.
Right. A tax savings is money in. It is effectively a negative fee on your account.
Explain that.
Well, if you are paying, say, 30 basis points under 0.3% to a wealth manager for a direct indexing solution, but their algorithm consistently generates 130 basis points of tax alpha for you, you have a net benefit of 1% in your pocket before you even look at what the underlying stocks actually did that year.
The service literally pays for itself 3 or 4 times over.
Exactly. It's a self-funding mechanism if the conditions are right.
And in a low return environment, let's say we enter a decade where stocks don't do much, that relative value becomes even more critical. Because if the broader market is only giving you, say, a sluggish 6% return, adding an extra 1.5% via tax savings is a huge proportional boost to your total return.
It changes the compounding math completely. Over a 20-year horizon, adding an extra 1.5% net can literally mean the difference between retiring comfortably and retiring lavishly. It's the miracle of compound interest applied to tax savings.
Okay, I want to take a step back and look at the history of this whole thing.
Yeah.
Because it feels like, suddenly everyone is talking about direct indexing. It's in all the glossy wealth management brochures. It's on the financial blogs. But this isn't exactly new technology, is it?
No, not at all. The underlying concept of separately managed accounts and loss harvesting has been around for decades. But historically, it was strictly the domain of large institutions and ultra-high net worth family offices.
We're talking about people with $10, $20, $50 million portfolios. Gated off for the ultra-rich.
Exactly. It was a white glove service.
Why was it gated off? What was stopping the guy with $100,000 from doing this in 1998?
Transaction costs, pure and simple. Think about trading in the 90s. It costs $20, $30, sometimes $50 to place a single trade with a broker.
Oh, man. I remember paying $29.95 for a trade.
Right. So if you wanted to physically buy 500 individual stocks to replicate the S&P 500, you were paying $10,000 to $15,000 just in upfront commissions to set up the portfolio.
That would eat up your returns instantly. Your alpha is gone on day one.
Gone. And then think about the daily maintenance. Every time the manager wanted to harvest a lost sell Coke, buy Pepsi, that's 2 more trades, another $60 out the door. The friction was just way too high for it to make mathematical sense for a smaller account.
Friction costs more than the tax savings.
Exactly. And the rebalancing would kill you. Plus, and this is a big one, you couldn't buy partial shares back then.
Oh, right. Fractional shares didn't exist.
No. So to buy the S&P 500 with the proper market cap weighting, you needed a massive amount of capital just to buy one single share of the most expensive stock, say Berkshire Hathaway or Amazon, and still keep all the other ratios correct.
You needed millions of dollars just to get the exact weighting right without throwing off the whole index.
You did.
So what actually changed? Why is it suddenly available on an app for someone with $100,000 today?
The technological shift was basically a perfect storm. 3 massive things happened almost simultaneously in the industry. First, as we all know, commission-free trading became the absolute standard. Transaction costs went straight to zero. That entirely removed the friction that was holding the strategy back.
That's the Robinhood effect spreading up to the major players like Schwab and Fidelity.
Exactly. They all had to go to zero to compete. Second, the advent of fractional shares. Now, you can buy exactly $5.32 worth of Amazon if you want. You don't need $3,000 for one share.
That allows you to build a perfectly weighted, diversified portfolio with a fraction of the capital. You can slice and dice the index however you want, right down to the penny.
Exactly. And I assume you can guess the third leg of that stool.
The computing power.
The algorithms.
Yes. Algorithmic portfolio management. In the old days, a portfolio manager, an actual human in suspenders, had to sit at a desk, look at a spreadsheet, and decide, okay, Bob has a loss in GE today. Should I sell it, and what should I buy?
Extremely labor intensive.
Very. Now, you have cloud-based software that scans tens of thousands of individual portfolios daily. It looks for those tiny losses, checks the tracking error constraints, verifies the wash sale rules, and executes millions of microtrades automatically in the background. It's not a guy shouting orders on a floor anymore. It's just code.
And this technological democratization is driving a massive industry shift. I've actually seen analyst predictions stating that SMAs will eventually completely overtake pooled vehicles like mutual funds and ETFs, just as ETFs systematically took market share from mutual funds over the last 20 years.
It makes total logical sense when you think about it. If you can own a perfectly tailored, custom-fit suit for the exact same price as an off-the-rack suit from a department store, why would you ever buy off the rack again? Direct indexing is the ultimate customization.
But let's talk about the environment required for this to actually work. Because this strategy doesn't perform the same in every single market, right? You need fuel for this engine to run. And that fuel is volatility.
Right. Tax loss harvesting thrives on chaos. It works best when things are bouncing around violently. If the market goes straight up every single day, just a perfect, smooth 45-degree line to the moon, there are literally no losses to harvest. You need stocks to go down to generate the tax benefit.
So looking back historically, major market events like the dot-com bust or the 2008 financial crisis must have been absolute bonanzas for this specific strategy.
Oh, there were massive wealth generators in terms of tax assets. The periods from 2000 to 2002 and obviously 2008 provided huge, deep banks of harvested losses. Investors who were direct indexing back then could harvest so many losses that they could literally offset their capital gains for a decade into the future.
It's almost a great psychological hedge too, isn't it? When the market is completely crashing and everyone around you is panicking and selling, you can look at your account and say, well, the market looks terrible, but at least I'm banking a huge tax asset today that I can use later.
It really is making lemonade out of lemons. It softens the behavioral blow of a bear market.
But then let's look at the flip side. Look at the post-2010 bull market. From 2010 to roughly 2018, it was just a steady, low volatility, relentless grind upwards.
Yeah, the golden era for passive indexing. But for tax loss harvesting, it was dry. The tax alpha dropped significantly during that decade, down to maybe 40 basis points a year for a lot of people, simply because there just weren't enough losers to sell. Everything was going up.
And then 2020 hit, the pandemic crash.
And volatility absolutely exploded again. We saw the fastest drop in market history, followed by an incredibly rapid, uneven recovery. Tax alpha jumped right back up to around 86 basis points or more in that period. The strategy essentially acts as a systemic dampener. When market volatility spikes and hurts your portfolio value, your tax benefits simultaneously spike to offset some of that pain.
I want to touch on something adjacent here because the sources mention it and it's always a hot topic for you listeners.
Yeah.
Crypto. I know we are focusing heavily on equities today, but how does this entire concept apply to the crypto space?
It's a really fascinating edge case right now, and it perfectly highlights why regulatory frameworks matter so much. Currently, crypto as an asset class lacks the rigid wash sale rules that apply to traditional equities.
Explain the wash sale rule briefly for stocks so we can compare.
Sure. In the stock market, if you sell a loser, say, you sell Coca-Cola at a loss, you cannot buy that exact same stock back for 30 days. If you do, the IRS disallows the loss. They say it's a fake trade. That is precisely why we have to swap Coke for Pepsi. We need a substitute.
Right. You have to buy something similar, but not identical.
But in crypto, because they are treated as property rather than securities right now, those 30-day rules haven't been rigidly applied.
Oh, wow.
Yeah. So you could theoretically sell Bitcoin at a massive loss at 10:00 a.m., legally realize that loss on your taxes, and immediately buy the exact same amount of Bitcoin back at 10:01 a.m.
That is incredibly aggressive harvesting. You don't even need a substitute.
It's turbocharged harvesting. You keep your exact position, you maintain your exact market exposure, but you immediately reset your cost basis and bank the loss.
That sounds like a loophole that won't stay open forever.
It absolutely won't. Regulators are looking at it very closely, so nobody should expect that to last. But for traditional equity investors, which is what direct indexing mostly deals with, we have to stick to the correlated substitute method, the Coke for Pepsi trade, to stay completely compliant with the IRS.
Okay, let's go even deeper into the analysis here. We keep throwing around tax benefits as this blanket term. But when you really look at it, there are actually different types of benefits happening simultaneously here.
Yeah.
It's not just one monolith. It's really three distinct layers of financial value.
Right. We need to decompose this to understand the true math of what's happening. The first, most obvious layer is the deferral benefit. This is simply the time value of money applied to taxes.
Break that down.
By realizing a loss today to offset a gain today, you are fundamentally choosing not to pay that specific tax bill right now. You are kicking the can down the road.
Okay.
And that means you keep that tax money invested in the market. Let's say you owe the IRS $10,000 this year. If you can harvest enough losses to offset that and not pay the $10,000 today, that money stays in your brokerage account. It continues to compound. If it grows at, say, 7% a year for the next 10 years, you've made a massive profit on money that technically belonged to the government.
It's literally an interest-free, non-callable loan from the federal government.
Exactly. Now, you might have to pay the tax eventually, maybe 10 or 20 years from now when you finally liquidate. But the growth on that money in the meantime is yours to keep entirely. That deferral alone is incredibly powerful.
Okay, layer two.
The character benefit. This is where the real arbitrage happens.
Arbitrage. I like that word.
Short-term capital gains, which are assets you've held for less than a year, are taxed at ordinary income rates. For high earners, depending on your state, that can be a 37% federal rate plus state taxes. You could be giving up half your profit. It's wildly expensive.
Right. Whereas long-term capital gains assets held over a year are taxed at much lower rates, usually around 20%, so nearly double the rate for short-term trading.
Right. Now, direct indexing is structurally very, very good at generating short-term losses because it's scanning daily and selling recent losers. If you can take those high-value short-term losses and use them to offset your expensive short-term gains from elsewhere, you are saving money at the highest possible tax bracket.
You're neutralizing the worst taxes first.
Exactly. You are essentially converting what would have been an immediate high tax liability into a future long-term low tax liability. You are legally changing the character of your wealth.
That is brilliant. You're trading a 40% tax bill today for a 20% tax bill a decade from now. And what's the third layer?
The ordinary income offset. This is smaller, but still relevant. The IRS currently allows you to use up to $3,000 of excess capital losses against your ordinary W-2 income, your actual salary, every single year.
$3,000 doesn't sound like a game changer for the types of multi-million-dollar investors we're generally talking about here.
It's not going to make or break a retirement plan, no, but it's a really nice little annual kicker. Over 10 years, that's $30,000 of your normal salary completely shielded from taxes. It buys a nice family vacation or covers some property taxes. It all adds up in the net return calculation.
Now, here is where it gets really interesting and maybe a little problematic for the whole concept. We have to talk about the decay. Because if you read the sources carefully, particularly the quantitative research from places like AQR, they suggest that this tax alpha isn't a perpetual motion machine. It eventually runs out of steam.
Yes. This is known as the curve problem, and it is something the glossy sales brochures often gloss right over. The reality is tax alpha is heavily front-loaded. It is highest in the first few years of the account, usually years 1 through 3.
Why is that? Why does it drop off?
Because you just bought the portfolio. Everything is hovering right around your original purchase price. Your cost basis is completely fresh. So if the market wiggles down just 5%, you immediately have a harvestable loss. The opportunity set is incredibly rich.
But over time, hopefully, assuming the economy grows, the market does what it's supposed to do and goes up.
Right. 5 or 10 years down the road, if the market has done its job, your stocks are up 50%, 100%, maybe 200%. Let's say you bought Apple at $50, it went to $200. And now the market has a nasty correction, and Apple drops to $180.
It dropped $20, but you can't harvest a loss because your basis is still $50. You still have a massive embedded gain of $130 a share.
Exactly. You run out of ammunition. You have what we call a frozen portfolio. The portfolio eventually consists entirely of low basis stock with massive unrealized gains. You are completely locked in.
And if you try to rebalance, say Apple has grown so much it's now 15% of your portfolio and you want to trim it back to 5% for risk management, You literally can't do it without triggering a massive tax bill?
You're trapped by your own success. So the pure tax alpha can mathematically decay to near zero after about 5 or 7 years if you just sit there and don't do anything to intervene.
That seems like a pretty fatal flaw for a long-term strategy. You sign up, pay the higher fees for the alpha, and 5 years later it evaporates. So how do we actually revitalize it? How do wealth managers keep this machine running indefinitely?
There are 2 main levers you can pull to unfreeze the portfolio: cash and charity.
Let's start with cash. How does that work?
This is all about continuous cash infusions. If you are an investor still in the accumulation phase of life, meaning you are actively adding new money to the account every month or every quarter, you are constantly buying new shares at today's current prices.
So you're adding fresh, high-basis shares to the pool.
Exactly. Those new shares are fresh fodder for the harvesting algorithm. They have a high cost basis. So if the market dips next month, those specific new shares can be harvested for losses, even if your older shares are still sitting on massive gains.
Got it. So this strategy fundamentally works best for accumulators, people who are still working, still earning, and actively saving, not just retirees sitting on a static lump sum pile of cash.
Correct. If you just dump $1 million in on day one and walk away for a decade, the benefit decays rapidly. If you feed the beast with monthly deposits, the benefit persists.
The second way charity is the one that really caught my eye when researching this. It feels almost like a magic trick.
It is widely considered the killer app of direct indexing. It is the single most efficient, mathematically elegant way to handle a frozen portfolio.
Walk us through the exact mechanics of this, step by step.
Let's say you have that frozen portfolio we talked about. You have shares of Google that you bought years ago. They have tripled in value. You have a huge $50,000 embedded gain in those specific shares. Now, let's also assume you are charitably inclined. You give $10,000 a year to your local church or your university alma mater, or maybe a local hospital.
Normally, I'd just sit down and write them a check from my checking account.
Right. You write a cash check. That's fine. The charity is happy. But from a wealth management perspective, it's highly tax inefficient. With direct indexing, the software intervenes. It scans your account and identifies the specific tax lots, the exact shares of Google with the absolute highest appreciation, the ones with the biggest embedded gains that are locking up your portfolio.
Okay.
Instead of writing a cash check, you instruct a system to donate those specific shares of Google directly to the charity or perhaps to a donor-advised fund.
So I electronically transfer the stock itself, not cash.
Yes. The charity receives the stock. They generally sell it immediately because they want the cash for their operations. But because they are a registered 501c nonprofit, they pay zero capital gains tax on the sale. They get the full $10,000 market value. And you, the donor, get a tax deduction for the full $10,000 market value on your return.
Okay, so the charity is thrilled and I get my write-off. But how does this actually help my frozen portfolio?
Here is the key to the whole trick. You just completely avoided the capital gains tax on that Google stock. You effectively washed the game entirely out of your portfolio. Those highly appreciated, low basis shares are gone forever. The tax liability vanished.
Okay.
And this is the vital final step. You take the $10,000 in cash from your checking account that you originally would have written the check with, and you use it to buy new shares of Google inside your direct indexing account.
Oh, wow. So I still own the exact same amount of Google.
You own the exact same economic position in Google, but your cost basis on those shares is now instantly reset to today's high price. If Google drops 5% next week, boom, you immediately have a harvesting opportunity again. You have successfully revitalized the tax alpha engine.
That is incredibly brilliant. You're flushing out the toxic embedded gains through charitable giving and simultaneously refilling the tank with high basis cash.
Exactly. That synergy combining tax loss harvesting with structured charitable giving can sustain that tax alpha essentially indefinitely. The quantitative research suggests potential benefits of 80 basis points or more annually in the long run if you pull that lever consistently and correctly. It completely solves the decay problem.
But in finance, it absolutely requires you to be someone who actually gives to charity. If you aren't naturally philanthropic, that lever simply doesn't exist for you.
Correct. You can't fake it. You have to actually be willing to part with the capital and give the money away.
Let's pivot for a minute to the skeptic's view, because we are making this sound like a flawless wealth-generating machine. But I'm looking at some industry pushbacks, specifically an article from advisor perspectives, and they are throwing a little cold water on the party. They ask a very simple, very valid question. Is the complexity really worth the fee?
It's a highly valid challenge that every investor needs to ask. Direct indexing fees have definitely come down due to scale and competition, but they are still around 30 basis points typically for a retail investor. That's $3,000 a year on $1 million portfolio.
Right. And a standard S&P 500 ETF like VOO costs, what, 3 basis points? That's $300 a year. That is a 10x difference in structural cost.
A 10x difference. You have to be really, really sure that the tax alpha you're getting is real and consistent to justify paying that spread every single year.
Exactly. And the skeptics argue that there is a much cheaper, much simpler alternative that gets you halfway there. Segmented ETFs.
Right. It's essentially the poor man's direct indexing.
Explain that strategy for us.
Instead of buying 500 individual stocks and paying the 30 basis point SMA fee, you just buy the 11 major sector ETFs that make up the S&P 500. You buy a low-cost ETF for technology, one for healthcare, one for energy, one for financials, and so on. You mathematically replicate the broad index by holding its component sectors.
And the logic there is that you can still harvest some losses without the massive complexity.
Yes. If the broad market is up, but the energy sector tanks due to oil prices, like it did in 2014 or early 2020, you sell the energy ETF, you harvest the sector level loss, you buy a different, highly correlated energy ETF as a proxy to avoid the wash sale, and you keep moving. You don't need expensive software to manage 500 individual stocks.
But isn't that a really blunt instrument compared to the algorithm?
It is incredibly blunt. It's lumpy, as we say in the industry. Think about that energy sector example. You might have Exxon down 15% on bad earnings, but Chevron is up 15% on a new discovery.
So they cancel each other out.
Exactly. The overall energy ETF might be perfectly flat for the month. If the ETF is flat, you have zero losses to harvest, period. But if you were in a direct indexing account, the software would have precisely targeted Exxon, harvested the 15% loss, and ignored Chevron. With segmented ETFs, you completely miss out on that idiosyncratic risk, the single stock volatility that actually drives the engine.
So you trade precision for simplicity.
You do. The empirical data strongly shows that single stock volatility is much, much higher than aggregated sector volatility. So the opportunity set for daily harvesting is significantly larger and richer with direct indexing.
But the skeptic argues that the segmented ETF approach still gives you some decent tax benefit, maybe grabbing the low-hanging fruit with much less complexity, way lower management fees, and much less tracking error risk.
It's a solid middle ground. If you have a $200,000 account, segmented ETFs might actually be the mathematical sweet spot for you after fees. But if you have $2 million or $5 million, the extra absolute dollars generated by direct indexing easily justify the higher fee.
Okay, let's talk about real-world implementation and risks. Because we've established this isn't for everyone, I want to build a profile for our listeners. Who is the ideal textbook candidate for direct indexing? Who should actually be calling their advisor to sign up for this today?
We can comfortably narrow it down to three main profiles where this works best. First, and most obviously, high tax brackets.
Because it's a tax strategy.
Right. It's just simple math. The absolute monetary value of a tax loss is strictly proportional to your marginal tax rate. If you are retired, living in a zero tax state like Florida or Texas, and you are in a relatively low income bracket, a $1,000 harvested loss saves you very little actual cash.
Right. If your effective tax rate is only 10%, that $1,000 paper loss only saves you $100 in real life.
Yeah.
Big deal. It might not even cover the 30 basis point fee.
Exactly. But if you are a high-earning executive living in California or New York, facing a 50% combined state and federal marginal tax rate, that same $1,000 loss saves you $500 in hard cash. The government is effectively subsidizing half of your market losses.
Yeah.
The higher your taxes, the more valuable the specific strategy becomes.
Okay, so profile 1 is the high earner in a high-tax state. Who is profile 2?
I call it the hedge fund investor. And I don't mean you literally run a hedge fund. I mean you invest like one. Maybe you're a highly active trader, or you get compensated heavily in short-term options, or you constantly flip real estate.
People who generate a lot of short-term gains.
Yes. If you have systematic, recurring short-term capital gains, which again are heavily taxed at ordinary rates, you desperately need a machine that continuously generates short-term losses to offset them. Direct indexing is exactly that machine. It is a highly efficient loss harvesting factory that neutralizes your trading gains.
It's the perfect pair trade for an active stock picker.
Yeah.
You pick the winners in one account, and the algorithm automatically generates the losers in the SMA to shield your profits. And the third profile?
The philanthropist. If you are already giving significant regular money to charity annually, this is simply the most mathematically efficient way to structure your portfolio to maximize both your wealth and your giving power.
If you fit those profiles, the math is a slam dunk. If you don't, the fees might actually outweigh the benefits and you're better off in VOO. Now, talk to me about the risks, because things always go wrong. What are the landmines here?
Tracking error is the big operational one. This is the constant risk that your customized, sampled portfolio deviates negatively from the benchmark index you were trying to track.
Because you only own 140 stocks instead of 500.
Exactly. If you were sampling, you might just underperform the S&P 500 purely by bad luck. You might have left out the one mid-cap stock that went up 400% that year.
You picked the wrong 140 stocks.
Or the algorithm did, despite its best estimates. Now, managers usually hard cap this tracking error in the software settings, usually around 1% maximum deviation, but it is a real persistent risk. You might look at the financial news, see a headline that says market hits all-time high, log into your account and see that you are actually slightly down for the week.
Oof. That hurts. That creates massive behavioral friction. You start doubting the strategy, you want to tinker with it, or abandon it entirely.
It absolutely does. It requires discipline.
And then there's a specific compliance trap mentioned in the sources called the wash sale trap that frankly terrifies me. Because as we know, the IRS sees absolutely everything.
This is a major compliance nightmare if you aren't careful. The IRS looks at all your accounts across all institutions, and they also look at your spouse's accounts. It's called the spousal rule.
Oh, man. So it's aggregated at the household level.
Yes. Let's say your fancy direct indexing algorithm at Schwab sells Apple today to aggressively harvest a $5,000 loss. Great, it did its job. But on that exact same day, over at Fidelity, your spouse's passive 401k automatically reinvests a quarterly dividend and accidentally buys 2 tiny shares of Apple.
Boom. Wash sale triggered.
Instantly. The entire $5,000 loss is completely disallowed by the IRS because the household bought the security within 30 days. The automated SMA systems are very good at scanning themselves, but they cannot legally see into your spouse's completely separate 401k or your outside IRA.
So you have to be incredibly careful about overlapping holdings across your entire financial life.
You do. If you have direct indexing running in one taxable account, you generally should not own the core S&P 500 ETF anywhere else in the household unless you meticulously turn off automatic dividend reinvestment everywhere. It requires coordination.
That seems like a massive administrative headache. And speaking of headaches, the annual tax return, let's talk about April 15th.
Oh, Schedule D. It's a beast. If you own a standard ETF, you get one simple 1099 form in the mail with one single line item for your capital gains. You hand it to your accountant, they type in one number, and you're done.
Easy.
If you have a direct indexing account, because the algorithm is trading daily, you might have 800, maybe 1,200 individual line items of microscopic stock sales for the year. Your 1099 PDF might literally be 50 pages long.
My CPA is going to absolutely hate me.
Most modern tax software handles the electronic import pretty seamlessly now, and the major custodians provide consolidated summary reports that make it easier. But yes, if you have an old school CPA who charges by the hour or by the physical form, your tax prep bill is going to go up significantly. You have to subtract that extra accounting fee from your net tax alpha to see if you're actually winning.
Before we get to the final ultimate question of this deep dive, I want to quickly touch on customization beyond just taxes. Because once you've gone through the trouble of unbundling the index into individual stocks, you can actually do a lot of other interesting things with it besides just harvesting losses.
You can. This is what the industry calls the values and concentration aspect of SMAs. With a pooled ETF wrapper, you are forced to take the good with the bad. You buy the S&P 500, you fundamentally own Philip Morris, you own Exxon, you own defense contractors, you own everything. You can't opt out.
But with direct indexing, because you control the ingredients, you can apply custom screens.
Exactly. Like ESG, environmental, social, and governance screens. Maybe you want the broad S&P 500 returns, but you morally object to tobacco companies or private prisons or fossil fuels.
You just click a button in the software to exclude them?
Yes, you exclude them, and the algorithm automatically reweights the rest of the 490 stocks in the portfolio to keep the tracking error as low as theoretically possible. It gives you a personalized, clean version of the S&P 500 that aligns exactly with your ethics.
And what about concentration risk management? The sources mention this, and I think it's huge for corporate executives.
It is arguably the most valuable non-tax feature. Say you are a senior engineer working for Apple. You have massive annual stock grants. Your base salary comes from Apple. Your year-end bonus comes from Apple. Your future pension is tied to Apple.
You are talking Apple exposure.
Exactly. Your human capital is entirely tied to one ticker symbol. The absolute last thing you need is more Apple exposure inside your diversified retirement portfolio.
Because if Apple tanks, let's say a major product fails, or they face huge regulatory fines, you might lose your job, your bonus, and your retirement portfolio all in the exact same day.
Total financial disaster. Now, if you buy SPY, the standard S&P ETF, you are forced to own roughly 7% Apple. You're increasing your risk. But with direct indexing, you can tell the manager, buy me the S&P 500, but physically exclude Apple completely. And you know what? While you're at it, structurally underweight the entire tech hardware sector just to be safe.
Wow. You are highly customizing your beta to specifically hedge your personal career risk.
Precisely. You can't do that with an off-the-rack ETF. It's a very practical, highly structural application of unbundled ownership.
Okay, we have covered a ton of ground here. We've done the mechanics, the history, the granular math of tagged alpha, the major risks, and the customization options. Now let's get to the one question. The question that you say every single investor absolutely needs to ask before they sign the SMA paperwork and turn this machine on.
This is the ultimate deal breaker. The question is, what is my specific concrete plan for the eventual liquidation of this portfolio?
Why is that the most critical question?
Because direct indexing, by its very mathematical nature, creates a portfolio with a profoundly low-cost basis over time. Remember, the algorithm has been diligently harvesting all your losses for 20 years. It systematically threw out all the losers and rigidly kept all the winners. So after 2 decades, your entire portfolio is sitting on absolutely massive accumulated unrealized capital gains.
It's essentially a ticking tax time bomb just sitting in your brokerage account.
Exactly. If your ultimate retirement plan is to just hit the sell all button at age 65, liquidate everything to cash, and go buy a yacht and a house in Aspen, you are going to trigger a catastrophic tax bill.
Because you will instantly realize 20 years worth of deferred capital gains in one single giant lump sum on a single tax return.
Yes. You might push your household income into the absolute highest possible marginal tax bracket for that year.
And doing that could mathematically wipe out every single dollar of the tax alpha benefit you spent 2 decades accumulating. You didn't save any money, you just delayed paying it until it was taxed at a much higher rate.
It could entirely unwind the deferral benefit. The math turns against you violently. This strategy works best and frankly, arguably only makes mathematical sense if the underlying assets are never actually sold during your natural lifetime.
Wow, you essentially have to hold them until death.
It sounds grim, but purely from a wealth planning perspective, it's true. You either donate them aggressively to charity to wash the gains, as we discussed earlier, or you hold them and pass them directly to your heirs when you die.
Because of the estate tax loophole, heirs get what's called the step up in basis.
Exactly. It is the ultimate tax loophole in the American system. If you die holding that highly appreciated, low basis, direct indexing portfolio, your children inherit those exact shares at today's current market value. The cost basis steps up.
So the 20 years of embedded capital gains tax liability.
It vanishes. It is completely legally forgiven by the IRS. It goes to zero. Your heirs could sell the entire portfolio the day after the funeral and owe absolutely nothing in capital gains taxes. That step up is the ultimate realization of the tax alpha.
They say death and taxes are the only 2 certainties in life. But in this specific strategy, death actually solves the tax problem.
That is the fundamental nature of high-end estate planning. If you plan to spend all your principal during your life to fund your lifestyle, direct indexing might eventually become a mathematical trap. But if you plan to leave a generational legacy, it is an absolute financial superpower.
That is a crucial distinction for listeners to understand. It's a legacy tool, not necessarily a personal spending tool.
Correct. You have to know what the end game is before you start playing.
So, to conclude, let's wrap this massive deep dive up. Direct indexing is essentially an ongoing algorithmic arbitrage on the U.S. tax code. It actively trades complexity, meaning more line items, more pages on your tax return, more wash sale rules to dodge for pure yield enhancement.
It creates that invisible tax alpha. But as we've laid out, it is absolutely not a simple set it and forget it solution for the average retail investor. It is high maintenance plumbing. It decays rapidly over time unless you actively feed it with cash or flush it with charity. And it is really truly designed for the high net worth investor who has the outside gains to actually absorb those harvested losses.
In a world where traditional market edges are rapidly disappearing, where it is harder and harder for even the smartest guys on Wall Street to beat the market by just picking better stocks, the most reliable, mathematically certain edge left might just be aggressive tax efficiency. Because at the end of the day, it's not about what you make in the market, it's about what you actually keep.
I really couldn't have said it better myself. It's boring, it's administrative, but it's wildly profitable.
And that is exactly what we are here for, finding the profit in the details. But, before we sign off, it leaves me with one final thought to mull over. We talked about how this entire incredible machinery relies entirely on the current structure of the tax code, the step up in basis, the wash sale loopholes in crypto, the exact delta between short and long-term rates.
Right, the whole foundation.
What happens if, or maybe when, Congress radically changes those rules? What if the step up in basis is abolished to fund a deficit? Or algorithm-driven harvesting is classified differently? The greatest alpha generator of the decade could be wiped out with one single pen stroke in Washington. Something to think about as you build these 30-year legacy plans.
Regulatory risk is the silent killer of all tax strategies.
Absolutely. Well, that's it for this deep dive into the underlying plumbing of the market. Thanks for listening to Talk Tickers.